a delight to connect with Ridham Desai of Morgan Stanley, and I just want to bring this point out for our viewers that over the course of last couple of years, Ridham's been bullish and he's been right. He's been predicting the market recovery, the earnings recovery, and more importantly, the India positioning in terms of the advantage it seems to be enjoying. He's been a big proponent of the way how digitization is moving, and certainly seems to be, has over the course of years, has really been advising clients and perhaps in this case our viewers also to stay bullish. So what are his thoughts currently? How is he currently connecting the dots when there are so many moving parts? Ridham, fantastic to have you on ET Now. Thank you for joining us. Too many moving parts, right? There is a Trump trade one side, there is a long-lived China trade on one side, and there is a sell India expensive trade or quit India movement which FIs have adopted. So just like your frame is shaking, a lot of things are shaking in the world right now, right?
Yeah, sorry about that. I'm on the sidelines of our Singapore summit, and it is crazy busy out here. I've got 3,100 plus people moving around in a single hotel. So
3,000
it's
people
been
in
hard to.
Singapore. I always thought Singapore was a small, tiny island city.
No, people have come from all over the world. So yeah, it's a little bit challenging, the logistics here. But yeah, to your question, yes, of course, there are moving parts, Nikunj. There's nothing different from any point in time in life. There are always moving parts, except that the parts that are moving keep changing. And then some surprises and curveballs come at you. But yeah, I think you summarized this well. I think from an India perspective, there are, I think, three imponderables. The first one is what happens to global growth next year, which in turn will depend on how the new president frames his policies. The second is what happens to India's growth. There's a lot of skepticism following the slowdown that we've witnessed over the last 6 months, that India is going through a prolonged soft patch of growth. And the third is the point you made about about portfolios that foreign portfolio investors are selling, and what is the demand that is there for Indian equities, and the valuations being one of the aspects relating to that. So on the first part, global growth, I think that remains a bit of an imponderable. We will have to wait for the president to roll out his policies. I think India on a relative basis is okay. And therefore that relative trade favors India. The absolute trade depends on the extent of the policy that gets rolled out in terms of tariffs. Our base case is that global growth will still be okay next year. A bit of a slowdown from where we are today, but not anything material. There is an offset coming from the Fed rate cuts that we expect. So that should be fine. So far as we are right about our forecast, I think India is in a good place. So we won't have to worry about it. But in case we reach a bear case scenario where the policy rollout is far more restrictive than we are currently assuming, then of course that challenge will emerge, especially in the second half of next year. With regards to India's own growth, I think the soft patch was temporary. It was a very peculiar one. The first quarter of this fiscal was obviously hurt by elections. The second quarter was hurt by incessant rains in August and the advancing of Shraddh to September. The government cash balance with the RBI by the end of September had almost touched 3.6 trillion rupees, 3,60,000 crores, unprecedented. That's the extent to which government had deferred expenditure. Central plus state governments are 29% of GDP, and the expenditure for the central government fell by 0.5% in the first 6 months of this fiscal. And as a consequence, fiscal deficit was tracking 3.4% versus a target of 4.9 and versus last year's number of 5.9. So you can imagine what drag it produced on the economy. Well, guess what? All of that is behind us. The government's cash balance is now down to sub 60,000 crores. So over and above the taxes they collected between 1st October and now, they have spent 3 lakh crores. So the economy should actually be doing quite well now. On top of it, we have a very strong summer crop that's coming into the market, a 5.7% growth in the Kharif output. So farm incomes are looking good. And we have a wedding season that started on Kartik Purnima a week ago, and that is promising to bring a much higher growth rate versus last year because it's a longer wedding season. So I dare say, I think this quarter ending December is going to be very strong. And I think the skepticism about any slowdown in growth is going to be quickly behind us. RBI has shifted the stance, and liquidity in the system is now more or less in surplus, which augurs well for the growth prospects. So I don't think there are much domestic worries for us. And with respect to the foreigners, I don't think this was an India-specific sell down. It was an emerging market trade as the US dollar was pricing in President Trump victory, and it was rallying through the month of October. I think emerging markets saw major outflows. India and China put together are almost half the EM index, and they both saw major outflows. China's outflows exceeded India. So that may be, I think, done now. I think the correction that we got was a healthy one. And I think we're probably at the end of that correction.
Ridham, so, just wondering, what is the chatter that you're picking up on the sidelines of the summit? You think a large chunk of the FPI selling is now behind us? You just talked about as to how the selling was much an emerging market trade and not an India-specific trade. But nonetheless, we've seen the maximum amount of selling year to date, and we're at a what? The outflows are at a 10-month high. You think a large chunk of that is now behind us?
You see, the conundrum here is that at 9:15 every morning, there is a domestic bid that is there on the screen. There are only two participants in the market, domestic buyers and foreign portfolio investors. So both can't be buying at the same time. Somebody needs to sell. So unless the corporate sector steps up its activity and brings more issuances into the market, I don't see the foreign investor selling, totally go away. The intensity of the selling can ebb, which in fact has already ebbed. But it is mathematically not possible for everybody to be buying in the market. Somebody needs to sell. Now, the question that I will ask you is that which one are you more comfortable? If domestic starts selling to allow foreigners to buy, would that make you more comfortable? I don't think it will make me comfortable. I think we're better off with domestics buying rather than foreigners. We won't want the same intensity of selling. And I do think the intensity of selling has maxed out. Now, if corporate issuances continue to pick up, then you will see foreign buying come back, because then they will have room to actually bid for stocks. In the meanwhile, as we know, domestic buying actually made record highs as well, as much as foreign selling made record highs. And I actually focus on that a lot more, because for months now, a lot of investors have been quizzing me about the sustainability of the retail bid, that if the market corrects 10%, retail will panic. Guess what? They didn't panic. They actually backed up the truck and loaded it. So I think that's a very comforting sign for us, for those who are actually not so much for me, but for those who have been skeptical about the sustenance of the retail bid.
Okay, now one big assumption for FY25 was government spending, and something which you alluded to. If things normalize, which is that the government will increase their government spending and then they will go back to that budget capital expenditure target, where do you think the market in a sense could be delighted? Could it be infrastructure? Could it be cement? Could it be both?
So see, Nikunj, the government has very clearly articulated its strategy in February itself in the interim budget, and then reiterated that even more strongly in the final budget, that it is stepping away, that the heavy lifting that it did during COVID, when private demand was weak because of the extraneous factor of COVID, is now done. And the fiscal stimulus that it gave to the economy is therefore behind us. So very clearly, we are on a path of fiscal consolidation. In fact, it's a very bullish story for equities because it is possible that in the next 3 years, the Indian government will go into a primary balance. And your viewers need to understand what that means. Currently, the Indian central government is in a primary deficit, which means it is borrowing money to pay interest. And if a corporation did that, you would call that corporate bankrupt. By the way, almost all the top countries in the world are in primary deficit. They're all borrowing to pay interest. India will be one of the rare exceptions on the planet which will stop borrowing to pay interest in about 3 years. When that happens, government debt to GDP will fall because nominal GDP in India is still doing 10, 11%. It will create major space for the private sector to relever. Private sector borrowings or debt is at cycle lows. So I expect a major lending boom in the private sector, which will be accompanied by a big capex cycle. So that is how India's growth template pans out over the next 3 years. Now, coming back to the F25 thing, the thing is the government spending was lagging GDP. That's how fiscal deficit consolidates. And in this year, the government was hoping and anticipating that the private sector will step in. We did have a few extraneous factors that I think has hurt this narrative, but I think those are all behind us, and we should see a catch up in the second half. Now, on the mix of spending, where clearly the government is focusing on infrastructure, even though it's losing share in GDP, nominally infrastructure spends will still go up, and that will remain the strong part of the government spending story. It is not redistributing taxes. I do think there's scope here to cut indirect taxes as you go forward because government tax collections are very strong, but that is not so easily done as it was in the past because now GST rates are to be determined by the council, and the council will have to come to a consensus, and states have to agree that they are ready to give up some revenues in order to restructure GST. But if that happens sometime next year, it will be very bullish because it will actually stimulate a lot of private consumption.
Okay. So Ridham, I'm just going to start putting the pieces together just for the benefit of our viewers here. Point number one, Ridham, this is a cyclical slowdown according to you. All bull markets, they go through cyclical slowdown. All earning cycles, they go through cyclicality, and we are going through a typical cyclicality within a bull market cycle. And the bull run and the earnings cycle is not over. We could be 40%, we could be 50%, we could be 60%. That's only the debate. That's point number one. Point number two, you expect a lot to change on the macro front, whether it is on the GST, tax collection, interest rates, which in a sense could be the trigger point for 2025. So one has to construct the recent macro developments on the global front, the recent leg of decline in equities, assumptions that macros would be better, and government in a sense will be leaving spectrum for private sector capex to pick up. Where do you see scope for outperformance in this market, and where do you see scope of underperformance in this market? Ultimately, Ridham Desai से सब वही जानना चाहता है, क्या लेने का, क्या बेचने का?
Yeah, so I think you described it well, except that I would not even call it a cyclical slowdown because by its very nature, cyclical slowdown is something that goes on for months. This was really a seasonal thing. It was a temporary thing. So it'll be over in weeks rather than months. But aside from that, I agree with your description of what I'm saying. Now, I think the low-hanging fruit and the hardest trade here, which is always the case with low-hanging fruit, because low-hanging fruit is the least attractive to people. People want to go for the fruit that's hanging high up the tree because it looks juicier. But the low-hanging fruit is private sector, large private sector banks. They're trading like utility stocks. Utility stocks, by the way, are trading like growth stocks. 10 years ago, the large private sector banks, the top ones used to trade at 3, 4, 5 times book, and the utility stocks were trading at 1 to 2 times book. Now, utility stocks trade at 4 to 5 times book, and the private sector banks trade at 2 times book. So I think if you want to make a trade, it requires an enormous amount of patience to go through this because I don't know when the tide turns. Everybody is very cautious and skeptical about the banks, but that's, I think, the trade you want to put on in the market right now. So that to me is the low-hanging fruit, but it's difficult to digest this because it may not give you immediate gratification. The second place I think is in areas of discretionary consumption. I think the rural economy has mended. It took a little longer time than I anticipated. I would have thought the rural economy should have turned last year, but it only turned in February this year. So coming out of COVID, rural India took longer to witness the transfer of terms of trade from urban India, but that is now set. And therefore, I think consumption will actually see all-round recovery. The slowdown in urban consumption that a lot of consumer companies are complaining about, I think is temporary. Now, within consumers, though, you have to be a bit more nuanced because there are certain companies that are running into stiff competitive competition. Their moats have been diluted, and there are other companies that have very strong moats. So, to my mind, for an investor looking to pick stocks, you have to assess the moat of that particular business. And any business that is subject to intensity of competition will not deliver the growth that you need to make money. So that's the nuance in consumer. Also, the second thing is that because India's per capita income is rising, discretionary consumption will grow much faster than staple consumption. And there are new areas of discretionary consumption, which Nikunj, you and I have been discussing over the last 2 years. And I think we are only seeing reiteration of those trends, whether it is with respect to quick commerce, whether it's respect to leisure, travel, education, entertainment. I think these areas are certainly going to grow faster than soaps and staple stuff. So that's consumption. I think in the industrial space, things have become more interesting. I was a bit more skeptical because of valuations when we last spoke. But over the last couple of months, some of these valuations have corrected quite steeply. And so there is an opportunity now that has emerged in re-engaging on industrial stocks. And the most controversial idea remains IT services. I think people are worried about the long-term impact of AI. But I think over the next 3-4 years, AI is going to be an area where IT services will likely experience a boom. As companies around the world try to build products around the AI infrastructure that has been built so far, I think Indian IT services companies will start getting a lot more orders. So I would be constructive on that space. And then I would avoid everything else. The only one that I'll add here in addition to all these, because it doesn't actually fit these four, is cement. So cement has gone through a rough time. Pricing has been under pressure. Companies are sitting at very low margins, and usually that's a good time to buy stocks. I think over the next 12 months, I won't be surprised if these margins recover quite significantly. So cement is a place that investors should look at as well. And it dovetails into the industrial boom and the capex that we are seeing on the ground.
Ridham, you've done a lot of work on the JAM Trinity, the digital infrastructure which is getting created. And over the years, you've also expressed the fact that you need to bet on these big waves. And I'm making this question slightly descriptive for the benefit of our viewers. When internet started, the big winner actually was Amazon. When smartphone was implemented, the big winner was the Uber economy. If AI and digital infrastructure is getting implemented, how can investors really benefit from this trend?
See, I think the biggest thing that India's digital, so AI and digital are two different things. So first I'll take digital. The biggest thing that will happen with the layering of India's stack is that credit will get democratized and it will become ubiquitous. Today, credit doesn't reach the depths of Indian society. The lower strata of Indian society is still in the clutches of money lenders. And it will democratize in a fashion that I think we will underestimate. So the trade there is to buy the large banks with good deposit franchises and good risk controls, because they will be the biggest beneficiary of this democratization of credit that I think is underway. AI is a slightly different debate, Nikunj. And frankly, I have to admit that I am not fully, convinced about whether I understand what this is going to bring about. There are a lot of views out there, and things are still developing. The scope and the impact of AI will only unfold in a few months, and then we will be in a better position. There is a possibility that India's services sectors hurt in the long run, but it's a possibility, it's not a guarantee, and we'll have to watch that. There will be a lot of productivity gains that will come our way. I think some of the conventional moats that companies had, like distribution, will get challenged because it will become easier to access the market. It will become cheaper to access markets. So if you had a great distribution on which you relied to sell your product, that may not be a moat going forward. So the implications, I think, are still unfolding. And let's wait for a few months before I conclude on exactly what to do with it. But digital, I think, is straightforward. Credit is getting democratized in India. That 70% odd number that we have on private credit to GDP, I think, is going into 3 digits over the next few years.
Okay, good to know. And Ridham, just going by the observations in the report, there's also a view on how the deep tech sector in the country can, produce positive surprises and new listings. IPO growth industries is where you guys are looking at opportunities. Can you walk us through your observations on the recent IPOs, or where is it that you see promise?
Thank you for raising that point, because I missed it out. I think deep tech is something which should surprise a lot of people. At $2,500 per capita income, a country is not supposed to have a thriving deep tech sector like India has. And India has companies that are 3D printing rocket engines, are sending satellites into space, are extracting water from water from air, from the moisture in the air. They are doing quantum security and quantum computing and loads of stuff, which I think is very surprising. But I think it boils down to India's unending zeal for entrepreneurial ventures. And that is the reason why India differentiates itself from the rest of the world. It is exactly this entrepreneurial spirit that generates returns in the stock market. So it is now reflecting in the way people are taking risk on new technologies. These are not going to come to the market anytime soon, because I think they're still getting incubated. They'll probably come over the next 5 years. But yeah, certainly it will create exciting new opportunities for investors in the equity markets. Now, coming to the IPOs in the immediate term, clearly there are going to be a lot of PE exits. There will be companies that will raise money. And we are still very early in the IPO cycle. The trailing 12-month IPOs are only 0.5% of GDP. This number peaked at 3.5% in the previous cycle of 2007-8. 3.5% at current GDP, assuming that it makes a peak, say, in the next 12 months, will mean that India will raise $10 billion every month for 12 months on the trot. So we're nowhere close to that peak. It will happen, and that will, of course, mark the end of the bull market as well. But I think in the next few months, I think we will be spoiled for choice. A lot of high quality companies, as they normally happen in an IPO cycle, firstly, the high quality companies come and raise money or offer shares, and investors obviously make a lot of money. And then as the IPO cycle matures, lower quality companies will come, and then of course all hell breaks loose. So right now, I think at least in 2025, I would assume that there will be a bunch of high quality listings that will come our way.
Okay, that's good to know. And just give us a sense as to what do you believe are going to be some of the key risks when it comes to the domestic economy back home?
There are actually, the domestic economy does not have that many risks in the immediate future. So if we are focused only on 2025, I think the risk is largely global. The risk is that the global growth surprises to the downside. And that's a material risk for India, because 21% of India's GDP is exported. So if global GDP growth slows down, it will inevitably slow down domestic growth as well. So I think that's the key risk factor that we have to keep focused on in 2025.
All right. Good to have you on board, Ridham. Thank you so much for taking time out. Always a pleasure chatting with you on a plethora of topics, from macros to individual sectors, and of course, talking about things like AI and deep tech as well.
Thank you so much for hosting me.
If you like this video, then like, share and subscribe to ET Now.